Good morning, students. Welcome to the session of Cost and Management Accounting, Budget and Budgetary Control. This is CA Vibhavadhavan, and for the next two sessions, today and day after tomorrow, you will be with me for Budget and Budgetary Control. So by now, you must have covered all the modules of Cost and Management Accounting, Cost Accounting and Management Accounting, Computation of Cost, and a lot of decision making for management. Now today we are going to do another very important module, which is budget and budgetary control. So whatever we do implementation in the organization, the starting point is budget. All right. So let's understand a lot about budget, and we'll be understanding lots of budgets, how we make it, the format, and what is the significance of each and every budget. So let's start budget. Now, what is a budget? Budget is an instrument of management. So budget is actually for the management to plan, all right? Plan the future course of action based on the past performance. The budgets are made, and then of course they are revised subject to changes in the current scenario. So budget is an instrument of management used as an aid in planning. So whenever we talk about budget, we have to talk about planning, because it's the essence of budget is planning, estimating, forecasting, all right, and control of business activities. So a financial and quantitative statement. So budget could be only in quantitative terms, and budget could also be quantitative and cost both. All right. Good morning. Good morning. So many students have joined. Good to see. Happy morning to all of you. So it's a quantitative statement prepared and approved prior for a definite period of time. So of course, the budget accounting people, the cost accounting, who takes care of budgeting, they make the budget and then it is approved by the management. Only then it is implemented. All right, so that the organizational objectives are achieved. It may include income budget or expenditure budget or capital, employment of capital. So budget is a blueprint of the projected plan. Blueprint means it's just an estimate what we are going to do in the future. All right, so that is all about budget. Then budgeting, the whole process of designing and implementation, the process is called budgeting. So budget is an instrument, a format, a document, and the process of making budget is budgeting. Clear? So budgeting starts from planning, designing the formats, the plans, what all budgets will be made, how they will be made, the format of the budget, what the management wants the information, which type of information, and what all information the management wants in a budget. So the whole process of designing the format and what all budgets are required, then making the budget, then implementing the budget. So the entire process, and of course, the operation and control, the entire process is called budgeting. So the main emphasis of budgeting process is provision of resources to support plans which are being implemented. So what all budgets we are made, then we have to implement the budget. It's not that we have made the budget and, we have kept another drawer and we go to sleep. We have to implement the budget. So implementation is as important as planning, because we plan everything, but when it comes to implementation, we fall short of our own expectations. So implementation is a very crucial part of budgeting. Clear? When we have to implement, we have to see what all resources are required, and then we have to make those resources available. So there is a team who will be making the budget, who are responsible to make the budget, and there is a team who are responsible for implementation of the budget. Clear? So there will always be two separate teams, planning and the implementation. And implementation is so crucial. It depends upon implementation, whether that budget is successful or not, whether we are able to meet the standards set in the budget. Implementation tells us about too much about the organization and the efficiency. So it means coordinating the combined intelligence of entire organization into a plan of action based on past performance, rational judgment of factors, what all external, internal factors influence the business. So everything is taken into consideration to make the budget, to design a budget, and then to implement the budget. So the whole process is called budgeting. So what are the essential steps for budgeting? Yes, first of all, whenever a strategic move is being made, the most important thing is to make a strategy. All right. Strategy, the objectives, the vision and mission of any organization. So we always start with what are the objectives of any organization? You have to achieve that objectives at the end of the day. All right. Setting up of clear objectives and responsibility. Now, the second important thing is responsibility. Who is responsible for making a budget and who is responsible for implementation of the budget? So if there is a deviation, then the responsibility has to be fixed. So fixing of responsibility is equally important. Otherwise, the variations and the deviations, cannot be checked and cannot be improved. Budgets are prepared for future periods based on expected course of action. Budgets are updated for the events that were not kept into mind. So let us say budgets are made and then there was some event which was not forecasted earlier, but again, that event has to happen. So budgets are always revised. All right. Let us say there is unforeseen circumstance or there is some event which was skipped while making the budget. So budgets should have the scope to revise also. Otherwise, budget will lose its essence. We have made the budget and we are adamant, no, we are not going to change the budget and the circumstances have changed. How you can apply the same budget to change the circumstances? Clear. Let us say production, we have made the budget for the production of 1 lakh units and then suddenly COVID happened and the factory had to shut down. How can we apply that budget for 1 lakh units to something, a future period where the production falls down to 10,000 units? So you have to revise the budget. There should always be a scope to revise the budget subject to the circumstances which will change in the future. All right. So budget should be quantifiable and master budget should be broken down into various functional budgets. So different types of budgets are there. We'll be understanding what all different types of budgets we can make. Budget should be monitored periodically. Variances of actual outcomes should be compared, of course. So when we are making the budget, it's an estimate, it's a forecast, it's a standard. And then when actual thing happens, you have to compare the budget with the actual, so that the deviations can be monitored and checked and responsibility to be fixed. This is also more important because the next time when you make the budget, we should see that why the deviation. So that deviation or variances we should encounter and we should take into account when we make the next year budget. So that comparison is very important. If this time this much deviation, next time we'll improve. Why so much of deviation, right? Budgetary performance needs to be linked effectively to the reward system. So again, responsibility, when the people responsible will be identified, the responsibility will be fixed. So budgetary performance has to be linked to the reward system. So see, everything has to be incentive based. So if I have an incentive that, okay, minimum deviation, I will be rewarded. Of course, I'll make extra effort so that deviation is not there. You understand? That is the background of the preparation, how the organization what all steps are taken to prepare the budget. Budgetary control. Of course, when we make the budget, we implement the budget, we compare the budget with the actual. A lot of deviations happen, so budgetary control has to be in place. That means the deviations should be minimum, right? So it is the system of management control and accounting in which all operations are forecasted. So we estimate all the operations. We estimate the sales, the production, the material purchase, the material consumption, the labor, everything is estimated and planned in advance to the extent that actual results are compared then. So when the actual thing happens, then you have to compare with the budgeted. So when actual production happens, we have to compare with budgeted production, what we planned, and then what is the actual production, the planned capacity, the actual capacity, the planned raw material consumption, the actual raw material consumption. So budgetary control has to be in place, so that the deviations, the budget should be close to the actual performance, right? So budgetary control involves establishment of budgets, So of course, the budgets, you have to prepare the budgets first, then only you have to go to control. Continuous comparison of actual with the budget, revision of budgets after considering the changes in the circumstances. As I told you, whenever we make budgets, there always should be a scope to revise the budget according to the changed circumstances. Fixation of the responsibility for failure. That is very, very important because it keeps a check on all the people who are responsible so that they just don't casually make the budget. Responsibility is fixed if deviation occurs. All right. Moving further. So components of budgetary control system. So these are the different categories of budgets which can be made, not types, but the categories. So there's a master budget and there are all functional budgets. Functional budgets means all that components of a cost accounting department. So physical budgets are those budgets which are made generally in quantitative terms, only in units, not the cost. All right. So units are there. Let us like sales, production. So what are the units of sale, volume of sales we are planning to sell? Then what is the production units, output in units we are planning for the next year or for the budgeted period? Then so quantity of sales and production and inventory and manpower. So everything will be numbers, not the amount. So physical budgets. Cost budgets, of course, it will involve the cost. So there will be manufacturing budget, administration budget, research and development budget, advertising budget. So cost budgets will involve the cost outlay. Clear? What all cost we are planning under particular category. So that is a cost budget. Then profit budget, of course, it will include the profit element also. So sales budget in rupees, in amounts. Clear? So when we have sales budget in volume and then we can have a sales budget in amount also. Financial budgets like cash budget, one of the very, very important budget, a cash budget, capital expenditure budget, balance sheet. So everything involving the financial performance, that also. But so there are different, categories of budgets and different forms of budgets we make under the budgetary control. Good morning, students. A lot of students have joined. So Sheila, I just explained, see, budget is an instrument. Clear? Budget is a format. We have made a cash budget. So that is a format, that instrument. Budgeting is a process of making budget, right? So budgeting is how we design the budget, how we implement the budget. The entire process of making budget is budgeting. And budget is what actually you make. Clear? So it's a statement. Budgeting is a process, right? All right. Like account and accounting. Are they same? Accounts are profit or loss account. You are making an account. You are making a statement. Accounting is the process of making accounts, right? So similarly, budget and budgeting. Coming to budget manual. So budget manual is a very, very important document which includes every detail of every budget. All right. How many types of budget the organization is planning to make? What are the format of every budget? Which person is responsible to make which type of budget? Which person is responsible for implementation of the budget? So the format, the memorandum, the types of budget, the responsibility, the people who will be involved in making budgets, everything, every detail relating to budget has to be in the budget manual. So it's a master document. So anybody who wish to know about the budget of an organization, whosoever the internal people or the internal staff or internal departmental heads, they want to know about the budgets. So budget manual is a very good reference and a reckoner that they can always resort to understand the budgeting requirements of an organization. So budget manual is a booklet, all right, and everybody in the organization have access to it. So it specifies, of course, every manual, every document, every prospectus, whatever has to start with the objectives of that organization or that institution, right? So it specifies the objectives first, and of course, the strategic, the policy decisions. So the budget is made to decide how much an organization would earn and spend, all right? So it's a document which sets out responsibilities of the persons engaged in and the forms and records. So what all budgets, what will be the forms, what are the formats, what will be the set specifications, who will make the budget, who will implement the budget. Effective budgetary planning relies on provision of adequate information to the individuals involving in the planning process. So many of these informations are contained in budget manual. So whenever you're making a budget, you need a lot of information about the organization. So a lot of information can be provided to you in the budget manual. So you should always, whosoever is making the budget should always, go through the budget manual thoroughly to have a very clear idea about the budget manual. So contents of a budget manual, first of all, objectives, then the functions and responsibility of each executive, both regarding preparation and execution of budgets, procedures to be followed for obtaining the necessary approval of budget. So who will make the budget, who will implement the budget, and what is the procedure for approval of budgets? As I told you in the beginning, budgets has to be approved by the top management. So who is going to approve it? What is the procedure? What is the hierarchy? It has to follow some steps of hierarchy. Let us say the middle management, then the top management. So every stage of management will vet the budget, will verify the budget. So the procedure, the whole scenario, how the budget has to be approved, has to be cited in the budget manual. A form of organization chart to show who are responsible for preparation of each functional budget. So there are different types of budget and which level of management and what are the persons who will be responsible to make the budget. So everything has to be in the budget manual. All right. Sometimes short notes come in what are the budget manual. So contents of a budget manual, timetable, when, what is the timeline when this budget should be ready. So by July 31, that sales budget should be ready. Within 1 week, production budget should be ready. So the timelines about it, the manner of scrutiny and personnel to carry it out, reports, statements, forms, and other records. What are the forms and format and statements of how we have to make the budget, the accounts classification. Then the reporting of the remedial action, if there is deviation between budget and the actual, then where it is going to be reported and how it is going to be, what is the remedy if there is a lot of deviation. So everything, the entire process, the form, the hardware and the software of that budget, everything has to be clearly mentioned in the budget manual. So anybody who is reading a budget manual should have the clear-cut idea what budgets are all about, what type of budgets the organization is making, what all information they can find in the budget. If there is a deviation, who will be responsible, who has to approve the budget, everything about the budget has to be in the budget manual. So this is a master document when we talk about budget. All right. Hope you've understood the basics of it. So let's start with types of budget. So these are all the different, this is the umbrella of budget. So budget has to be capacity wise. Capacity wise means fixed budget and flexible budget. Fixed budget means it's not going to change. So if I've estimated production 1 lakh units, the budget will be made as per 1 lakh units. And it's not going to change according to circumstances. So fixed budget is generally made when there are no much fluctuations. Organization is running on production of 1 lakh since many years and there is no expected change. For the last 5-10 years, there is no change and there is no expected change in the next 5-10 years. So a fixed budget can always work. Flexible budget, generally organization makes flexible budget. In flexible budget, the budget can be changed according to the changed circumstances. So if we expect an increase in the production capacity or we expect an increase in the sales volume, then we can always increase the budget accordingly. So flexible budget, which we change, we can revise the budget. All right, that is flexible budget. So functional budgets are very, very popular. So sales budget, production budget. See, we have a budget for every functional activity. So sales, production, plant utilization, direct material usage, then direct material purchase. So direct material usage, that means consumption, then purchase. Then you have this factory overhead. So we have overheads budget, we have manufacturing budget, selling budget, administration budget. Then R&D budget, capital expenditure budget, cash budget, advertisement budget. So there are different types of budgets all under the functional budgets. Then a master budget. So master budget is everything into one. So you can say a replica of a cost sheet. It includes every element of cost. It includes every overhead, every cost, every function. So we can start with sales and then all the cost, and then we come to profit. So master budget means it's like, how you make a cost sheet, a complete statement of cost, which includes every element of cost in it, every overhead, every type of cost which we encounter in an organization. So that is a master budget. Master budget is broken down into different functional budgets. So master budget means complete raw material, labor, direct costs, indirect costs, all the overheads, all the profits, and then functional budget. So master budget is basically broken into different functional budgets. So raw materials, this separate budget, labor separate budget, factory overhead separate budget, raw material consumption separate budget. So we broke down the master budget into different functional budgets. And then period wise, long-term budgets, short-term budgets, and current budgets. All right. So these are different category of budgets. Majorly, we will be doing most of these budgets, which mentioned under this umbrella of budget. All right. So any doubts so far? All right. Good morning, students. So I'm glad that you must have understood. Okay, so let's start with just one illustration. Let's see, it will clear the concepts. Okay, so just take a note of this illustration, students. Once you do the illustration, you always understand the concept better. A factory which expects to operate 7,000 hours at 70% level of activity furnishes details. All right, so variable expenses, semi-variable expenses, fixed expenses. I hope by now you know what are fixed expenses, variable and semi-variable. And you should always remember how we, separate the fixed and variable out of semi-variable. What are semi-variable expenses? Any answers? Any answers? Semi-variable. What are semi-variable? And I need one example of a semi-variable expense. Anybody who can explain what is semi-variable? And I need one example of semi-variable. Let me see if any answers are coming. What are semi-variable expenses? By now you should be thorough with these concepts because, semi-variable cost you will encounter in almost every module of cost accounting. All right. This is the essence of a cost accounting. This is a fundamental which you should always remember. Clear? It's not something that it will come in that chapter only, then you will do. So some concepts are applicable in whatever modules or units you will do. So come on, any answers? Semi-variable? No answers? Nobody is clear about semi-variable? You must have covered semi-variable. I believe I have also made you do semi-variable somewhere with the sessions I took. How we split the semi-variable into fixed and variable. All right, so answers are coming. So Diksha is giving semi-variable is the expense consists of both fixed and variable costs. Yes. Karthik is saying to the extent they remain fixed and after certain interval, there's a change in cost. Electricity cost, yes. Darshan, very good example. Electricity, so semi-variable is which are fixed also and variable also. So when they will be fixed and when they will be variable. So one student has given example of electricity. See, electricity is yes a semi-variable, we can say till a certain units. Let us say till 500 units of your consumption. The electricity bill, a minimum electricity bill has to be 1,000. So if you are using 10 units, if you are using up to 50 units, up to 100, 200, till 500, you have to pay electricity bill of 1,000. So if you are using 10 units or 500 units, the electricity bill has to be 1,000. So whatever is the minimum amount you have to pay, irrespective of consumption or production. Clear? The minimum amount which we have to pay irrespective of consumption or production are the fixed cost. Beyond 500 units, it will be variable. So if you are using 600, so till 500, so your electricity bill will be 1000. And after that, it will be based upon your consumption. Clear? So it will be per unit. And a very, very important property of fixed cost. All right, there are generally two properties of fixed cost and variable cost. You should know. So there are two properties of fixed cost and variable cost. Number one, fixed cost remains fixed and in total. Variable cost per unit remains fixed. Clear? So fixed cost generally comes in total and variable cost generally comes in per unit. So fixed cost in total remains fixed and variable cost per unit remains constant. These two properties you should know. Fixed cost per unit changes and variable cost in total changes. Clear? So I'm repeating. Very, very important properties of fixed cost and variable cost, which you must have done. And these are very important concepts you should never forget. Fixed cost in total remains same till the maximum production capacity, of course. So in total, if fixed cost is 5,000, so generally fixed cost comes in total. All right. So it's like 5,000 rupees annual charge. So fixed cost will remain 5,000 irrespective of production. But yes, only till the maximum capacity fixed cost will be 5,000. Variable cost generally is denoted in per unit. And variable cost per unit remains constant. Clear? The second property, fixed cost per unit changes and variable cost in total changes. All right. So if I just tell you what I'm talking about. So this is total and this is per unit. Clear? So fixed cost and variable cost. So fixed cost in total does not change, but it changes in per unit. Why? Because numerator remains fixed and denominator changes, so per unit is going to change. Variable cost in total changes, but variable cost in per unit remains constant. All right. So this is a inverse properties of fixed cost and variable cost. You should always remember. Right. So coming to this illustration, a factory which expects to operate 7,000 hours at 70%. So 7,000 hours at 70%. So variable, semi-variable and fixed. The semi-variable expenses up by 10% between 85 and 95% activity. So they are saying when the semi-variable is going to change. And by 20% above 95%. So prepare a flexible budget. So we are talking about flexible budget. So first budget you will encounter here is flexible budget. Let me just erase it so that we can just start with the illustration. Okay. So we have to make flexible budget for 80%, 90% and 100% activity. So at 70% is already given. Clear? So start making 70 is already given. On the basis of this, we have to make 80%, 90% and 100%. Clear? So 70%, the number of hours are 7,000. 80%, the number of hours should be 8,000. 90%, the number of hours should be 9,000. And for 100%, the number of hours should be 10,000. All right. So these are the hours. So let's start the students. Let's start the illustration. So the 70% is given to you. On the basis of that, you have to make a flexible budget for 80%, 90% and 100%. Variable expenses. Students, you should always convert the variable expenses into per unit. Clear? So variable cost 1260. So 1260 variable cost is for 7,000 hours. What will be the variable cost for 8,000 hours? It will change in direct proportion. So how you, or you can convert it into per hour also. So 1260 variable cost, you should always convert it into per unit. Clear? 1260 variable expenses divided by 7,000 hours. Divided by 7,000 hours. So variable expenses comes to 0.18 per hour. 0.18 per hour. That is the variable expenses. Now 0.18 per hour. Hours are 8,000. Multiply by 8,000 into 8,000. It comes to 1440. So we have calculated variable cost as 0.18 per hour, 0.8 per hour. And we can multiply for 80%, 90% and 100% hours respectively. So can you tell me the variable cost per hour? Variable cost for 80%, 90% and 100%. Let me see who's doing. Okay. Yes, a lot of answers on semi-variable. Very good. That means you have an idea about semi-variable. Yes. So let's calculate variable cost quickly. For 80%, variable cost is 1440. We have calculated variable expenses as 0.18 per hour. How? Variable cost divided by hours. So variable cost is 1260 divided by 7,000 hours. The rate of variable cost is 0.18 per hour. So we have applied the rate per hour for 8,000 hours. Apply the rate per hour for 9,000 hours. Apply the rate for 9,000 hours. All right. So students have calculated 1620. I'm assuming it's correct and I'm writing it over here. And then 1,800. So variable cost has come to 1260. 1440. 1260 was already given. So on the basis of that, we have calculated, because variable cost changes in direct proportion with consumption or hours or whatever is the capacity. Coming to semi-variable now. Semi-variable. So given is 1,200. All right. 1,200 is given in the question. So the information about semi-variable, the semi-variable expenses go up by 10%. Between 85 and 95% activity. Between 85, that means till 80, the semi-variable has no change. Till 80, the semi-variable remains same. Semi-variable has to go by 10% only between 85 and 95. Clear? So, for 80%, semi-variable is going to be same. For 90%, till 95, there has to be 10% increase. So let's increase 10%, 1320. At 90%, semi-variable will increase by 10%. Clear? Because it has to increase only after 80%, 85 till 95. So 80% remains same, 90%, yes, 10% increase. Beyond 95, 20% increase. So for 100%, we have to increase 20%. So 20%. So this is 1,200. Plus 20%, 1440. Clear? So semi-variable, make a 10% increase at 90% and make a 20% increase at 100%. Any doubts so far in semi-variable? Yes, very good. So students are able to do it. It's always better to do along with me simultaneously so that you will understand where the doubts are coming. Then fixed. Fixed expenses will remain fixed, 1,800. Can you tell me fixed cost for 80%, 90% and 100%? Very good, Darshan. I'm glad that you have understood. So fixed expenses, students, any fixed, can you tell me fixed expenses for 8,000, 9,000 and 10,000 hours? For 7,000, that is for 70%, fixed costs are given in the question. Right? Fixed costs are given in the question. Come on, fixed costs for 80%, 90% and 100%. Yes. So it will be 1,800, 1,800, 1,800, right? Fixed cost remains same at all levels till the maximum capacity of any factory. All right. So this is the total cost, that variable, semi-variable and fixed cost. Calculate the total cost, students. Total cost at every capacity. Calculate the total cost for every capacity. 70% is already given. 80, 90 and 100. Calculate the total cost. Yes, fixed cost remain constant. Yes, very good. Now calculate the total cost. All of you, figures are before you. You also must have solved. So you must have the figures with you. Calculate the total cost, 70%, 80%. I should get the answers from your side. Only then you will understand. Otherwise, I will solve entire question and you will get confused. So it's always better you solve along with me so that, you will also do practice accordingly. Yes, fixed cost will remain same. So we have taken fixed cost at all levels the same. I'm waiting for the total cost. I'm waiting for the total cost. Any answers? Let me also do along with you. 1, 2, this is. Okay, so it comes to 4260. 4440. I'm solving along with you. 4740 and 5040. You just check your answer. Is it correct? So I've just solved it. I've just calculated the total cost. So 4260, 4440, 4740 and 5040. Rest. So that means I've also calculated correctly. So this is the total cost. Now you have the hours, 7,000 hours. So calculate the cost per hour. Calculate the cost per hour, per budgeted hours. So these are the hours given on top of it. And the cost is given. Divide the cost by the hours. Calculate the budgeted hours. Calculate their respective budgeted cost per hour. Calculate cost per hour, all of you. Calculate cost per hour. Calculate cost per hour. So it's absorbed cost per hour. Clear? As per the budget. So as per the budget, how much should be the cost per hour? Clear? That is the significance of a flexible budget. It will give you cost per hour at different level of capacity. I'm repeating, flexible budget gives you the total cost and the cost per hour also you can calculate at different level of activity. All right. So calculate cost per hour if anybody can, or let me just calculate. So for first, it is 0.61 per hour. For at 70% capacity, at 80%, it's 0.55 per hour. All right, cost per hour. Then it's 0.53. At 90% capacity, cost per hour is 0.53. And then it's 0.50 at 100% capacity. So the flexible budget has given you total cost at different levels of capacity and cost per budgeted hour also at different level of capacity. So if you are using any capacity, you have the flexible budget. So budget you can use accordingly. All right, according to the actual capacity which you are working. So we have the budget. Yes. So excellent. 0.61, 0.556. Okay, that's, you can write 56 or 55, 53 and 0.50. So this is cost per hour. All right, students. So let me see if there is a, okay. So there is a clear solution also. Take note of this solution. We have solved it. So this is exactly what we have done. So these were the budgeted hours. These are the variable expenses, 0.18 per hour. Variable cost is 0.18 per hour. Semi-variable, we have increased. Fixed expenses remain same. And these are the total expenses we have calculated. And yes, then the budgeted rate per hour. All right. So whatever capacity we are working, we have the budgeted rate. Right. So if in a particular month, the factory works for 8,000 hours, it will be the correct allowance should be 4440. If the actual expenses are 4,500, that means we have overspent. Clear? So budget gives us the idea what should be the cost. And then we compare with the actual, and then we have to find the deviation. Why we have overspent? We should have spent triple. So at 80% capacity, we should spend 4440. At 90% capacity, we should spend 4740. And then we'll compare with the actual cost. And then we find out the deviation. So that is the purpose and objective of the budget. All right. So yes, very good. So I hope students have understood. Let's move on. Do we have another illustration? Okay, so we have another illustration now. Just take a note of this illustration, students. A department of company X attains sale of 6 lakh at 80%. So sale of 6 lakh is at 80% of its normal capacity, and expenses are given. So administration costs are given to you. So these are the administration costs. Selling costs are given to you. All percentage of sales. Do we have another part of question? Yes. Distribution costs are given to you. So these are the distribution costs. So they are saying prepare flexible budget, add flexible administration, selling and distribution cost budget. So students, this is the cost budget. Clear? A flexible cost budget. So there are three different costs we encounter in every cost sheet you must have done. Administration, selling and distribution. So we have to make a budget citing administration, selling and distribution at 90%, 100% and 110%. So it was given for 80%. You have to make it for 90, 100 and 110. So see, 80% was given to you. You have to make, this is given to you. You have to make for 90%, 100% and 110%. So it's a good practice question. Let us say the starting point has to be sales. So sales at 80% is 6 lakh. Sales as 80% is 6 lakh. So sales at 80% sales. Sales at 80% is 6 lakh. Clear? Can you calculate the sales for 90%, 100% and 110%? Yes, can you calculate the sales for 90%, 100% and 110%? What Khushi is asking, 10,000 units. No, it's Khushi, you have to understand the language of the question. All right. So it has to be when it's talking about semi-variable, it's talking about from the original value, not at the value of 90%. All right. So we should always do, if it's saying 10% and then 20%, that means you have to assume it's saying we have to start from 1200 only, not 1320. All right. These are the mistakes the students make. But again, if you want to do it, you can always write a note. But sometimes when you do a lot of questions, you will understand what the question tries to say. So do it at 1200 and write a note. It's always better to write a footnote or a study note so that the examiner knows that you understand the concept and you know to do it both ways. Yeah. All right, so we have the sales coming here. So for 80%, 6 lakh, then 6 lakh 75,000. I got the answer for 90%. 7 lakh 50,000 for 100%, and 8 lakh 25,000 for 110%. Yes, so many answers are coming. So we have to take this as the final sales. We have got the sales. Now let's start with the, you have the administration. Now administration cost, and then you have the, I'm writing it over here, okay? Then you have the selling cost, and then you have the administration cost. So you have to take all the three costs. You are making a budget at different level of capacity. Why it is called a flexible budget? Whenever you are making a budget at different level of capacity, it becomes a flexible budget. Now, so flexible budget can be made for sales also, for cost also, for income also. So you can make a flexible budget for anything. Here we are making a flexible budget for cost. Clear? So let us talk about, okay, administration cost. So start with administration cost. There are 4 categories of administration cost: office salaries, general expenses, depreciation, rates and taxes. All right. Can you give me the amount for 90% first? Administration cost. Students, take the note of administration cost. Take the note of administration cost and calculate the administration cost. First, let us calculate administration cost for every capacity. So calculate administration cost for all the capacity. 90, 100 and 110. So you have 4 categories. Okay. How sale we have found? If the sale at 80% is 6 lakh, Vishali, how will be the sales at 90%? So 6 lakh, do along with me. 6 lakh into, you have to calculate for 90%. So into 0.9 divided by 0.8, it will come to 6,75,000. Clear? So you have to just calculate in direct proportion to the change. So if at 80% is 6 lakh, what will be at 90%? This is mathematics, simple mathematics. So into 90% divided by 80%, you will get 6,75,000, right? I hope you have understood, Vishali. Now, how we have calculated at 100%? 6 lakh into 100% divided by 80%. Because 6 lakh is 80%. So 80% should be the denominator. All right. So this way we have calculated. Those who have not understood. So this way sales has come. Coming to administration cost. Okay. So do we have the answers for administration cost? Office salary. Okay. Office salary. This is 90,000. Okay. So office salary 90,000. Office salary is 90,000. Let me see. Okay. Students, office salary 90,000. I'm writing it over here now. 80%, 90%, 100%, 110%. Here, office salary will remain to be 90, 90, 90, and 90 since it's fixed. Office salary is a fixed administration cost. So it will remain same for all the levels of activity. Coming to general expenses, 2% of sales. You know the sales, right? You know the sales for every capacity. Here are the sales we have calculated. So these are the sales. 6 lakh, 6,75,000, 7,50,000, 825,000. We have the sales for every level of capacity. And the general expenses are 2% of sales. You know the sales, calculate 2%. Calculate 2% of sales. Can I have the general expenses for every level of capacity? General, this is 6 lakh into 2%, 12,000. General expenses come to 12,000 for 80%. Can I have other answers? General expenses are 2% of sales. For 80%, it's 12,000. For 90%, 6,75,000. Yes, it's 13,500. Somebody has calculated here. I'm looking for general expenses. Okay, then 15,000. Diksha, I'm writing your answers. I hope they are correct. 15,000, Arya also calculated, and 16,500. So general expense is 2% of sales. You know the sales. Calculate 2% of sales. You know the sales of every level of capacity. Depreciation, 7,500. It's considered to be fixed here. So depreciation is considered to be fixed. Depreciation is considered to be fixed in the absence of any information. Depreciation is considered to be fixed. Rates and taxes. Rates and taxes to be considered as fixed. Rates and taxes to be considered as fixed. Right? So we are considering it also as fixed. So total administration cost, you can calculate. Students' office salaries, depreciation, rates and taxes are considered to be fixed. All right. General expenses are the only variable administration cost, which is 2% of sales. So total administration cost also some students have calculated. Okay. So 118,250 total administration. So I think you can calculate the total. Let's come to selling cost. Selling cost is generally 100% variable. So selling cost, all variable. Why? Because it's a percentage of sales. You know the sales, just calculate 8% of sales, 2% of sales, 1% of sales, and 1% of sales. So students, this you can safely calculate. Please calculate the value of salaries, traveling expenses, sales office, and general expenses, and give me the amount. quickly. Let me calculate and just write the amount here. So must write total administration cost, all of you. 118250 total administration cost. I'm taking the answers. Some students have calculated 119750, 121250, and 122750. So this is total administration cost. Selling cost, it's all percentage of sales, and you know the sales. Clear? So just calculate selling cost. 8% of sales. Can I get the answers? Salaries, all right. So I've got the answer for salaries. It's 48,000 for 80%. 54,000, 60,000, and 66,000. So I'm taking these answers, I assume, to be correct. So salary is 8% of sales. I've written the amount. Traveling expenses, 2% of sales. So it will be same as general expenses. So 12,000, traveling expenses, 12,000, 13,500, 15,000, and 16,500. Clear? So that is traveling expenses, 2% of sales. I hope you know the sales. All of you know the sales by now. Clear? 1% of sales, 6,000. 6750, 7,500, 8,250. Okay. So these are expenses, and same general expenses also same. So calculate the total of selling cost. We have the total of administration cost. Lot of calculations, but at least you will get practice how we do the flexible budget. Flexible budget we make for different levels of activity. Okay. So selling cost, calculate the selling cost, total selling cost. Calculate the total selling cost. It's 72,000. If I just do it, 81,000. This is for 81,000. Here 90,000 and 99,000. So total of selling cost we have, total administration cost we have. Yes, very good. 72,000, 81,000, 90,000, and 99,000. That is the total of selling cost. Let's move to distribution cost. Let's move to distribution cost now. So this we have done. Okay. Do the distribution cost now. Wages supposed to be fixed. If nothing is given, no information, consider it as fixed. Wages are fixed. Consider is the fixed expense. So wages are fixed. Rent, 1% of sales. You know the sales. I think you can calculate. Other expenses, 4% of sales. You know the sales. Calculate. Very quickly calculate the distribution cost. Let's complete this question quickly. Total distribution cost I'm looking for. Total distribution cost, and then you have to calculate total cost, total of administration, selling, and distribution. All right. I'm writing the total distribution cost. 45,000. I'm writing the total distribution cost. You just calculate the rent and other expenses. All right. It's just a percent of sales. I think you can calculate. Total distribution cost 45,000. 48,750. I'm writing the total here. 52,500 and 56,250. So I've written the total distribution cost. All right. So you have the total administration, you have the total selling, you have the total distribution cost. Calculate the total cost as per flexible budget. Total cost, total of selling, distribution, and administration and a different level of capacity. Total cost now. 235, 250, 235, 250. Total cost as per flexible budget. 249, 500. Just check your answers. It's a good practice question for flexible budget. Of course, a lot of calculations, but not very difficult to understand. All right. So flexible budget gives us the scope to change the budget as per the changed circumstances. The total cost, check your answers. This is the total cost before you. Let me show you we have the solution. Yes, we have the solution. Good, we have the solution. So I think you can check the figures. So this is the different levels of capacity. All right. So these are the administration costs, these are the selling costs, and these are the distribution costs. So total administration, total selling, total distribution, and then this is the total cost. The total cost and the different level of activity. Students, take a note of the final answer. Then we'll move forward. Understood? Any doubts so far? We have done a couple of questions on flexible budget. So different types of questions can come. You can make a flexible budget for anything. Flexible budget can be made for income and expenditure both, because you can make a flexible budget at different levels. So sales also different levels you can make, expenditure also different levels you can make, cost also different levels you can make. All right, very good. So if you have got the same answer, that's excellent calculation, because in costing there is a lot of scope for calculation mistake, because a lot of calculations have to be done. So the question appears to be simple sometimes, but the calculation, make you lose marks. All right. So just be very, very careful in your calculations. So I hope you must have got the note of the final answer moving forward. All right, we have another illustration. Just read the illustration carefully. All right. So the action plan manufacturers normally produce 8,000 units of their product in a month in their machine shop. So normal production is 8,000 units. For the month of January, they had planned, clear? So that is the budget, planned, for a production of 10,000 units. So normally production comes to 8,000. For January, they have made a budget for 10,000 units. Owing to a sudden cancellation of a contract in the middle of January, they could only produce 6,000 units in January. All right. The budget for January was made for 10,000 units, but they could only produce 6,000 units due to some unforeseen and unavoidable and abnormal circumstance. Indirect manufacturing costs are carefully planned and monitored in the machine shop, and the foreman of the shop, foreman, you understand, who takes care of the instruments and the machines inside the production area. The foreman of the shop is paid at 10% of savings as bonus when in any month the indirect manufacturing cost incurred is less than the budgeted cost. All right. So if the manufacturing cost, the actual cost is less than budgeted, the foreman of the shop gets paid a 10% of the savings. So whatever is the difference in the cost is reduced. So whatever is the difference in the decrease in cost, he's paid 10% of savings. And normal capacity, maximum capacity is given. How to find total cost of fixed cost? I don't understand what exactly you are asking. Which question you are asking? And maximum capacity, how do you find total cost? I don't understand what exactly you are asking. So just elaborate. By the time, let's move to the question again. So the foreman has put a claim that he should be paid a bonus of 88.50 rupees for the month of January. The works manager wonders how anyone can claim a bonus when the company has lost a contract. The relevant figures are under. So you understood? The normal capacity is 8,000 units. The planned capacity for January was 10,000 units. But due to some abnormal reason, the actual production actually came to 6,000 units, right? So let's see what are the figures given to us. All right. So indirect manufacturing cost is given to us. Expenses for a normal month. Normal means 6,000 units. Expenses for normal means 8,000. Sorry. Expenses for normal means for 8,000 units we have been given. Planned for January. That means these are expenses which are given for 10,000 units. The planned. And actual cost is for 6,000 units. Actual cost is for 6,000 units. You got it? So for normal month, that means the normal expenses are for 8,000 units. The planned expenses must be for 10,000 units. And actual cost in January was for 6,000 units. All right. So students, we have different types of indirect cost here. Do you agree with the works manager if the foreman is entitled to bonus or not? So you have to actually substantiate your answer. See, this is the normal, this is the planned, and this is the actual. But we planned for 10,000 and abnormal was 6,000. That was actual. So we have to write the planned. We cannot compare 10,000 from 6,000. Clear? We have to compare the budget with the actual with the same units. So we have to calculate that would have been planned for 6,000 units. We need to calculate the planned expenditure for 6,000. Only then we can compare the actual from the planned. All right. Then only we'll come to know what are the savings. Are there any savings or not? We cannot compare 10,000 from 6,000. So 6,000 were actual. We have to calculate what would have been planned for 6,000 on the basis of the whatever figures we have been given. Clear? So we have to calculate every category of expense as budget for 6,000 units first. Only then we'll come to know whether we have saved or not. Clear? So let's see. So we have to see the nature of every expense. All these expenses, some of them will be variable, some of them will be fixed, and some of them will be semi-variable also. How you will find which expenses are fixed, which are variable, and which are semi-variable. All right. So salary of foreman. Salary of foreman, it's fixed or variable. What do you see? We have to find out whether the expenses are fixed or variable or semi-variable. Clear? Salary of foreman, fixed or variable or semi-variable. What do you see? You have to see the pattern of this. Salary of foreman, 1,000 at 8,000, 1,000 at 10,000, 1,000 at 6,000. That means it has to be a fixed expense. Clear? So at 6,000, it has to be 1,000 again. So what's the difference? What is the difference between actual and planned? Difference is nil. There is no difference. Clear? So salary of foreman has to be fixed. Since it's fixed at every level, it has to be fixed when we make a budget for 6,000. So there is no difference in the salary of foreman when we have actual cost at 6,000 units level. Clear? Indirect labor. Indirect labor, is it fixed or is it variable or is it semi-variable? Yes. Salary of foreman is fixed. What about indirect labor? What you're asking, Satya, I'm not able to get your question. Which question you are talking about? How would I know which question you are talking about? In the question given like this, which question you are talking about, Satya? Fixed cost per unit, 10 rupees normal capacity. What is 10 rupees normal capacity? 10,000 units, maximum capacity 15,000. I don't know which question. I'm not able to I'm not able to judge what exactly you want to ask. Let's move to the question again. Indirect labor, yes, it should be variable. Indirect labor should be variable. How would you come to know that an expense is variable or semi-variable? See, the cost is 720. So 720 divided by 8,000. 720 divided by 8,000. Calculate the per unit cost. Per unit cost comes to 0.09. Now multiply 0.09 into 10,000. Now multiply 0.09 into 6,000. What does it come? It comes to 900. It comes to 600. That means it's a pure variable cost. If the variable cost per unit is same, that means it's a variable cost. So 0.09 into 10,000 comes to 900. 0.09 into 6,000 comes to 600. That means it's a variable cost. So apply to 6,000 here again. All right, 0.09 into 6,000. Now calculate. Find out for indirect material also. Yes, find out. Now this is actual. Okay, so here it will be 540. How you calculate? 0.09 into 6,000 comes to 540. So is there an incremental or a decremental? Is there increase in cost? Yes, 60 rupees is the increase in cost. All right. Students, indirect labor is a variable cost. How you have to check or how can you check? 720 divided by 8,000, 0.09, apply for 10,900, apply for 6,540. This is the actual cost. It will remain to be same. This is actual. All right. So this is not as per the per unit. So 540 for 6,000 and increase in cost is 60. Indirect labor, the cost should be 540 as per the planned expenditure, but the actual cost came to 600. So the increase in cost happened to rupees 60. Clear? Similarly, indirect material, please calculate whether it's variable or fixed. Calculate for indirect material. Indirect material, variable or fixed. Again, how you will calculate? Cost is 800. 800 divided by 8,000. Here, 800 divided by 8,000, 0.10. So 0.10, 0.10 into 10,000 comes to 1,000. So yes, it is also a variable cost. So then multiplied by 6,000 also. So it will come out to be 600. It will come out to be 600. So the incremental cost is 100. The planned indirect material should be 600, but the actual indirect material came to 700. So the incremental cost is 100, right? So it is also variable. Indirect material is also variable. All right. I'm erasing it off again. I hope you understood how we do it. Coming to repair and maintenance, variable or semi-variable or fixed. Just check. 600 divided by 8,000, 0.075. 0.075 into 10,000. It's 750. No, repairs and maintenance is not variable cost. Repair and maintenance is not variable cost. Repair and maintenance. Which type of cost is repair and maintenance? Come on, repair and maintenance is which type of cost? Is it variable? Is it fixed? Repair and maintenance. Any answers? No. Repair and maintenance is semi-variable. Repair and maintenance is semi-variable. If you will calculate 600 divided by 8,000, it's coming 0.75. Right? 600 divided by 8,000. It's coming 0.075. 0.075. Now you multiply 0.075 into 10,000. It should come as 750, but it is coming as 650. That means it's not a variable cost. All right. It has to be variable cost. It should be multiplied by the variable cost per unit. It's not variable cost. It's semi-variable. Now, how you segregate semi-variable into fixed and variable, students? You should know by now how we do it. I'm doing it over here. See, repair and maintenance at 8,000, the amount is 600. At 10,000, the amount is 650. What is the difference? Difference is 50 rupees. So difference of both the units. Okay, amount, difference of amount and both the units, and difference of units. Difference of units is 2,000 and difference in amount is 50. Different in amount is 50 and different in units is 2,000. So calculate the variable content. We have to segregate semi-variable into fixed and variable, right? So it has to be 0.025 variable cost. Variable portion under this has to be 0.025. 0.025 into 8,000. 0.025 into 10,000. Segregate the variable portion first. So this is the variable part. 0.025 into 8,000. That means variable is 200 rupees. Out of 600, variable is 200. That means the balance 400 is fixed cost. Similarly here, variable cost is 250. Out of 650, variable cost is 250 and the fixed cost remains to be 400. Repair and maintenance is a semi-variable cost. How you segregate semi-variable into fixed and variable? You have to pick the variable portion first. How you calculate the variable cost out of it? Difference in amount divided by difference in quantity. Difference in amount is 50. Difference in quantity is 2,000. Variable cost per unit comes to 0.025. Multiply 0.025 with 8,000 units. The variable cost comes to 200. The balance out of 600 is your fixed cost, that is 400. Repeat the exercise at 10,000 units. Multiply the variable cost per unit into 10,000. So variable cost should be 250. And the balance out of 650, that means 400 is fixed cost. So under repair and maintenance, fixed cost has to be 400. Coming to our 6,000 units now, 0.025 into 6,000. Apply it for 6,000. 0.025 into 6,000. 150. 150 has to be variable. And fixed cost remains same. So the amount should be 550 for 6,000 units. The amount should be 550 for 6,000 units. You have to apply the variable cost per unit for 6,000 now. That comes to 150 and fixed cost remains fixed at every level. So fixed cost comes to 400. It will be 400 for 6,000 units also. So variable cost 150 plus fixed cost 400. The total comes to 550. Clear? I'm erasing everything else so that you understood now. So that is 550 when we talk about this. All right. So 550, how much is the incremental cost? There is no incremental cost. All right. Yes, 50 rupees has to be the 1 minute. So it should be 550 and the actual cost is 600. So the incremental cost is rupees 50. So repair and maintenance, very important in direct cost. which is semi-variable. So this way you have understood how we segregate semi-variable into fixed and variable. Now just find out the cost for the next one on the similar basis. The next, so this is semi-variable. Power. Calculate, students will take a break of 5-7 minutes. For the time being, between that time, you just see whether power, tools consumed, rates and taxes, depreciation, insurance. All right. Insurance is fixed. Clear? So insurance is fixed, no change. Depreciation is fixed, no change. Clear? Rates and taxes fixed, no change. So students, in this 5-7 minutes break, you have to find out about power and tools consumed. Power and tools consumed, whether it's variable, semi-variable, tools consumed, whether it's variable and semi-variable, and be ready with the amount. All right, I'm repeating. I'm taking a break of 5-7 minutes. In that break, you just find out about power and tool consumed. It's variable or semi-variable, right? And if it's semi-variable, please segregate into fixed and variable and calculate the amount for 6,000 units. Rates and taxes, depreciation, insurance, all three are fixed. So you have to calculate for power and tools consumed, all right? So we'll come back after a break of 10 minutes. By the time being, you please do it, all right? Okay, students. So I hope you must have identified power and tool consumed. So power, what about power? Variable or semi-variable? What about power? Any answers here? No answers for power. Okay, power is semi-variable. How can we say that it's semi-variable? Let's check. So power is 800 and 875, right? So 800 divided by 8,000 is, this is power, right? Yeah. 800 divided by 8,000 comes to 0.10. So 0.10 multiplied by 10,000 should be 1,000, but it's 875. That means it's not a variable cost and it's not a fixed cost also, because it's 800 and 875. So it cannot be fixed cost also. It has to be semi-variable cost. Now, how we segregate semi-variable cost? Now I'm erasing it off. So how we calculate the semi-variable cost? Difference in amount. Difference in amount is 75. 800 and 875. Difference in amount is 75. Difference in quantity, 8,000 and 10,000. Difference in quantity is 2,000. So this way we will find out the variable cost portion. Clear? So how much will be variable cost in this? 75 divided by 2,000. Variable cost has to be 0.0375. Variable cost has to be 0.0375. Now calculate the variable portion. 0.0375 into 8,000. So variable cost will be 300 and balance has to be fixed cost. So it will make 800, right? Similarly here, I'm erasing it off now. 10,000 into 0.0375. So 10,000 into 0.0375. It has to be 375. So 375 should be variable and fixed cost remains same. So fixed cost will be 500. So total is 875. So out of 800, fixed cost is 500. Out of 875, fixed cost is 500. And we have segregated it into variable and fixed. So the way we do, we calculate the variable portion and the balance, the fixed cost comes, which will remain equal at every level. Clear? Similarly, let us do for 6,000. So 0.0375 into 6,000. How much is the variable portion? 0.0375 into 6,000. 0.0375 into 6,000. 225 should be variable plus 500 is the fixed cost. Fixed cost will remain same. All right. That means it has to be 775. 775. It has to be 775. Sorry, 725. I'm so sorry. It will be 725. So it will be 725 and the actual is 740. Any increase in cost? Yes, 15 rupees has to be increase in cost. So power is a semi-variable. I'm erasing everything else so that you understand. Okay. So I hope you have understood how we calculate it. Now, so power is a semi-variable cost. We have split the semi-variable into fixed and variable. 725 should be the cost for 6,000. The actual is 740. The incremental cost is 15. Yes. Coming to tools consumed very quickly. Let us complete the tools consumed. Tools consumed is variable. Let us see why it is variable. 320 divided by 8,000. 320 divided by 8,000, 0.04. Multiply 0.04 into 10,000. Yes, it comes to 400. So tool consumed is variable cost. Variable cost per unit remains same. Apply this variable cost to 6,000 also. 0.04 into 6,000. 0.04 into 6,000. It comes to 240. The actual is 300. So yes, the incremental cost is 60 rupees. Clear? So this way we have calculated I'm just erasing it off, everything which is not required. All right. So students, we have done with all the elements of indirect cost here. Salary is fixed, indirect labor variable, indirect material variable, repair and maintenance semi-variable, power semi-variable, tools consumed variable, rates and taxes, depreciation and insurance fixed. All right. So just do the total of all the incremental cost. Can we say there are savings? Okay. So one student has calculated. Okay, total incremental cost is 285. There is no saving, but there's an extra cost. So the works manager is wrong. The foreman is not entitled to any claim, and because there is an incremental cost of 285 and not savings. So we have to incur extra cost and there are no savings. Clear? So the foreman will not get, is not entitled to any bonus. So this is how you have to do this illustration. And this is what is the conclusion of this answer. All right. So, okay, very good. So students, 285, it's 285, I think. Just cross check the answer. It's 285 or 240. It should be 285. It's 285 or 240. Just cross check the answer. Whatever it is, it's an incremental cost, so there will be no savings anyhow. All right. Yeah. Okay. There's a this clear solution also. Just look at this. Yes, it has to be 285. Yeah. This is the incremental difference. This is the expenses as per flexible budget. So this is for 8,000. This is for 10,000. This is planned for 6,000 and this is actual for 6,000. So we will compare the planned with the actual at 6,000 units only. So both we will be comparing this and this 285. All right. So 285 should be the final incremental cost. Since there are no savings, the foreman is not entitled to any bonus. All right. A very good question to practice. It will clear the concept more so about semi-variable. All right. So the classification of costs. So let us move further. All right. Okay. So the sales budget. Now we'll be discussing different types of budget now. See, sales budget, students, is the starting point of any budgeting activity. All right. First of all, sales are forecasted. So once I know that this much is my sales, then we have to plan the production. Then we plan the production. So sales is generally the starting point. So sales budget is generally made first. All right. Once sales budget is made, then we plan the production. And once production is planned, then we plan the raw material consumption, and then we plan the raw material purchase. And then, of course, the labor and all the overheads. Clear? Okay. So the starting point is always the sales. So after sales, we'll plan the production. How much is the capacity? How much more capacity we require? How much less capacity we require? Then we have to, after production is ready, then accordingly we will find out how much raw material will be consumed. And this much raw material has to be consumed. Then how much raw material we should purchase? Maybe there is some stock also of raw material lying with us. So how much raw material we should purchase? Once we know the consumption of raw material, and then the labor and overheads and other costs follow. All right. So sales is the one of the most important budgets because every other budget is dependent upon sales budget. So sales budget should be very, very rightly forecasted sales. All right. So the quantity which can be sold may be the principal budget factor. Principal budget factor means every other budget will be dependent upon this, the sale units. The quantity of estimated sales, how much units we are planning to sell, the expected unit selling price, how much selling price we are expecting. In estimating the quality, the past sales volume, of course, we see what have been the past trends of sales. And then the expected future scenario, what is the market requirement, what is the customer requirement, any productive capacity. So these are the things which are taken into account when we forecast the sales. Clear? Backlog of unfulfilled sales order. So are there any backlog of sales order or advertising? Let us say there are huge advertisement going on now. We are promoting our products. So we expect a huge sales. All right. expected industry and general economic condition. If there's a recession in the market, economy is going down, so we can project a lesser sale than the last year. Productive capacity, we have increased the productive capacity, we can increase the expected sales also. So all these factors depend upon the forecasting of sales. And sales forecasting is the principal budget factor, because every other budget more so depend upon how much we are planning to sell. All right. Accordingly, we will produce. Accordingly, we will purchase from the market all the raw material. Accordingly, we will hire the staff, the labor, the skilled, the semi-skilled, everything. So everything is dependent upon more so on the sales. All right. Yes. So let's move on. So the sales budget. So this is basically a format, a general rough format. Every organization can have a different form of a budget according to their own requirement. If they want the sales budget according to the salesmen, some organizations want a sales budget according to the region, some they want a sales budget according to the product or according to the survey. All right. So depends upon what is the objective of the organization, what is the requirement of the top management, what all they want the sales budget. I mean, how they want the sales budget to be prepared. So here you can make a sales budget product wise. We can make a sales budget area wise, town wise, salesman wise. All right. And we can make a sales budget according to customers also. So if we have government also as our buyers, we have exporters also, we have home sales also, domestic sales, we have retailers, retail depots also. So we have to see what is the requirement of the organization. All right. Then we can make according to months and weeks. So there are so many ways in which you can draft a sales budget. So here it's just given a pro forma of one of the example how a sales budget can be made. So see, it's a product wise, product X and product Y. Product wise also we want to know quarter wise. So product wise, how much sales expected first quarter, how much was in the last year first. So first we should know how much was the actual sales last year in first quarter, second quarter. Accordingly, we will plan this year. Clear? So budgeted total year, then the northern region, southern region, central region. So whatever is the policy of the organization, accordingly we can make. So product wise, quarter wise and region wise. So something on the horizontal axis, something on the vertical axis. So this way we can make a sales budget. And yes, last year's sales, actual sales should be the starting point. All right. So this is what about sales budget. We will be doing questions so you will understand it. But this is one of the ways we can make sales budget. This is not a fixed format. All right. We can change the format as per the requirements of the organization. Production budget. Now after sales, generally we make a production budget. So production budget is a forecast of the production for the budget period. How much production we are expecting. It is prepared in two parts, volume, that means units, production in units, and the cost of production. So production budget can be made two ways, one unit wise, all right, and one the cost wise. So quantitative and cost budget, both can be made under production, clear? And how we can show the bifurcation, of course, material, labor, factory overhead. So when we talk about the cost, production cost budget should include the material cost, the labor, and the factory overhead. So it basically comprises of total production cost, right? So whatever production cost, whatever elements are constitutes the production cost, we have to include the forecast of every such production element. All right. Production budget shows the production for the budget based upon sales. Production budget is more dependently on sales budget. Then production capacity. If we do not have the excess production capacity, then, higher the sales, but we don't have the capacity. So we have to see the production capacity also. Accordingly, we have to make production budget, right? Planned increase or decrease in finished stocks, how much stock we want to maintain. So if we want to maintain higher closing stock, we have to produce higher production, clear? Policy, of course, the policy of the government and the organization. Production budget is normally stated in units. So generally production budget is made in units. Yeah. Production should be carefully coordinated with the sales budget. Production and sales budget should be coordinated so that they should be balanced. We should see how much stock we have to maintain and everything else we have to see. So production budget, we'll be doing all sorts of budget. So this is a pro forma of the production budget. Now this is the format we have to follow. We start with always the sales. So see, these are in units. Clear? Production budget generally is made in units. So 5,000 units of product A and 10,000 units of product B we are expected to sell. And closing stock, we are desiring to maintain a closing stock of 500 for A and 1,000 for B. So 5,000 we have to sell and 500 we have to maintain the closing stock. That means total requirement is 5,500. So we should have 5,500 in stock. Out of 5,500, we are expecting a sale of 5,000 and we would be maintaining a stock of 500. So total available quantity, which has to be required, the requirement is 5,500. Out of this, we have an opening stock of 1,500 also. Clear? We have an opening stock of 1,500. So this is required to be produced. All right. This is the production units budget. So this is the forecast of production units. Is it clear? I'm repeating. Sales forecast budget must have been made. Then we add the desired closing stock. This we have to maintain. So this is the total quantity required, less opening stock, the opening stock which we already have. And this is the production which is forecasted. So 4,000 units of product A and 9,000 units of product B requires to be produced in the budgeted period. All right. So this is the format, a very good format for production budget, which is based upon sales budget. We cannot make production budget unless we have made a sales budget. And also we should have how much stock we need to maintain. So the closing stock estimate also should be ready before we make a production budget. Clear? So accordingly, because opening stock, we know how much we have. So we have to estimate how much we want to maintain the closing stock. Accordingly, we can make the production budget. All right. So this is the format of production budget, a rough pro forma. Moving further, plant utilization budget. Now, plant utilization budget means the plant capacity. How much is the plant capacity? Do we have to increase? Do we have to decrease? If we have to increase, what all is required? This is very important because if we have to increase the plant capacity, we need to think because probably, a lot of capital expenditure is required if we have to increase the plant utilization. Clear? The capacity of the plant. Plant means the factory. If we have to increase the capacity of the plant, we should know how much capital expenditure it involves, all right? Because that's why it's very, very important budget because it can involve huge capital outlay, all right? Plant utilization budget represents in terms of working hours, weight or other convenient units of plant. So what exactly your plant capacity is denoted into, maybe it's for work labor hours or machine hours or any other unit. So you have to judge what is your plant utilization unit, and then accordingly you have to assess how you can increase that capacity. So the main purpose of this budget is to determine the load. How much is the load on each process or cost or group of machine, all right? If the machines are already overloaded and you have to increase the product capacity or plant capacity, you have to buy another machine. If the machine capacity is not overloaded, and it can produce more, then I think it can accommodate any increased production also. But if the machines are already overloaded and you further want to increase the capacity of the plant, you have to buy new machines, all right? So plant utilization budget is very important to assess, is there any capital expenditure which need to be made, all right? To indicate the process of cost centers, or of course, if there are any laborers or other staff, they have to work overtime, how to expand the production facility. If, it's a labor intensive organization, you have to prepare the laborers to work overtime or to hire new laborers if you want to increase the capacity. So if it is based on hours, you have to work out with the laborers and you have to work out with the new recruitments or new hiring of laborers. So accordingly, a lot of planning has to be done if you need to, change the plant utilization. To detail the sales production budgets, surplus capacity is available to make effort to boost sales. So if you have excess capacity available, then boost up the sales so that the production capacity is utilized optimally. All right. So that is all about plant utilization budget, again, which is a very important part of a budget. Direct material usage budget. Direct material usage means consumption. Usage means consumption. So once you know how much is your sales, once you know how much you have to produce, then the next step is you will find out how much direct material will be consumed. Clear? So let us say if you are producing 1,000 units and 5 kgs of raw material is used per unit. So that means you should have 5,000 kgs of raw material is the consumption. Clear? So raw material consumption you will find out only when your production budget is made. So once production budget is made, then you will assess how much raw material is required for consumption. And once you know this much raw material is required for consumption, then you will find out how much raw material you need to purchase. I require 5,000 kgs of raw material. Clear? So I require, if I write here, I require 5,000 kgs of raw material. This is the requirement. All right. Plus, I want to maintain a closing stock of raw material of 1,000. That means I require 6,000 kgs of raw material available with me. 5,000 is the consumption and 1,000 I have to maintain a stock of raw material for emergency also. So total raw material in the organization at every time should be 6,000. Minus I must be having some opening stock also. Let us say 500 kgs is there in the stock already. So how much to be purchased? 5,500 raw material should be purchased. So this is how the whole sequence is there. For sales budget, accordingly production budget will be made. Accordingly raw material consumption will be made. Accordingly raw material purchase will be made. All right. So it's a whole cycle and it's a whole sequence. All right. You cannot make raw material consumption before production or sales. So the quality standards of each item have to be specified. So which type of raw material you require for that particular thing. Standard requirement of each item of raw material. How much is the requirement? Standard means 5 kgs of raw material is required to produce 1 unit of output. So standard requirement, accordingly, you will make the consumption budget. And yes, you have to give due consideration to normal loss also. How much is the normal loss in the process? Clear? So if the raw material, you lose the raw material in process, then you have to take that also into consideration. The standard allowance for normal loss, past performance, test runs, technical estimates. So there are so many things which depend upon how much is the consumption of raw material. All right. Standard prices, after standing the quantities, then you prepare, multiply, and then we find out the consumption requirement. All right. Once you will do it, you will understand it better. But this is the essence of direct material consumption budget, that we have to see many factors, the standard requirement, the normal loss, the past performance, the test runs, the technical estimates, the prices of raw material, everything is important to make the direct material usage budget, right? So let's move on. Okay, so exactly this somehow let us understand. One example is given how we make it. So this is product A, 4,000 units must be the production. Product B, 9,000 units have to be produced. So production is ready. Production budget is ready. And from the production budget, we have assessed that we have to produce 4,000 units of product A and 9,000 units of product B. So this should be available before you make a consumption budget. Clear? Now, 12 units per finished product of material. So this is material. This is raw material. See, type of material. So this is raw material. 2 types of material, material X and material Y. 12 units of material X are used to produce 1 unit of product A. So how much units you require? 48,000. 12 into 4,000. 12 into 4,000. And for material Y, it requires 4 units per product A. So that means, and 2 units per product B. So 4 into 4, 16,000. So material Y, you require 16,000 units to product 4,000 units of product A. Clear? Similarly, for product B, material X, you require 1,08,000 units. It's in units. Clear? It's not amount, it's in units. You require 1,08,000 units of material X to produce 9,000 units of product B. And similarly, 18,000 units of material. So this is the consumption here. This is the total material X requirement. 48 for product A and 18 for product B. So total material X requirement is 156. Total requirement of material Y is 34,000, right? Material cost per unit must be with you. It's a market rate. So this is the material consumption cost. Clear? So this is how you make a material usage in units and in amount. Generally, it is made in units. So how we calculate in units? This is the one example. How we make the material usage in units. How much is the consumption required? And it is based on production budget. So students, I hope you must have understood so far. We'll be doing questions on this. Purchase budget. I told you, once you know how much material consumption is there, accordingly you need to plan the material purchase. Yeah? So you should have the consumption, plus you should know how much stock you are wishing to maintain and how much opening stock you already have. Then you plan the purchase, how much you need to purchase. Clear? So, and yes, we take into consideration EOQ and reorder and other safety levels. You must have done in your material chapter also. So accordingly, EOQ is how much to purchase. Clear? So we take all these technical analysis also to find out whether how much material we need to purchase. All right. So many factors we need to consider when we make any purchase, and we have to, so that these inventory levels actually help the management, that we should not be purchasing, in abundance, and there should not be deficiency also of stocks. So all these things really happen. So this is the material purchase budget, how we make, as I was telling you. Units required for production, it is the same figure which we have taken for consumption, 156 and 34. See here, from here we have taken this. 156, total requirement for material X. 34,000, the total requirement for material Y. So this is the total consumption, all right? This we have to have. This is the total consumption. Plus, this is the closing stock we need to maintain. So 156,000 is the consumption requirement, plus 3,000 over and above we need to maintain in stock. So total requirement of material is 159 and 34,500, total requirement. Out of that, how much material is already in stock, less opening stock? 4,000 and 3,000. So this has to be the purchase. So this much material in units we need to purchase. So material purchase budget can be made only after production and material consumption budget. Clear? So this is the consumption. This we need to maintain. This is the total we want the material to be in the organization. This much we already have with us as opening stock. So this much we need to purchase. The rates are already given as the same rates which we have taken in consumption. This is the purchase cost. So we should have the money to purchase material X and Y, and this should be the total material purchase cost. Total material purchase cost. All right. So this is the purchase budget, and the format: consumption plus closing stock minus opening stock. You get the material purchases requirement. All right. So this is all about material purchase budget. So we have understood sales budget, we have understood production budget, we have understood plant utilization budget, we have understood material consumption budget, and we have understood material purchase budget, right? All right, so we have an illustration now to understand the things better. Just take a note of this illustration, students. This is a mix of, again, the budget together. So we can make a combined budget also. This is whatever budget is this combined with a flexible budget. Why flexible? Because whenever I see at different level of activity, it becomes a flexible budget. All right. So ABC Limited is currently operating at 75% capacity. In the past 2 years, the levels are 55 and 65. Okay. So the past years are 55 and 65. The current is 75 and the projected they want at 85. So they want us to make a budget. The projected is 85. 55 and 65 are the past. 75 is the current. And 85 is the future, the projected one which we have to make. So we have to make for 85 only because rest is already is given. Direct material, direct labor, factory overhead, selling overhead, administrative overhead. Profit is estimated at 20% on sales. So you have to make a full budget. You can call it a master budget also. All right. Because sales is there. Every element of cost is there and profit is also there. So master budget under the flexible mode. Clear? So you have to make a master budget at different levels of capacity. All right. So we are actually doing a master budget since it will be starting with materials and labor and all elements along with the profit. So just see direct material, again, it's variable. So I think you should know the value for 85% also. If 11 lakh is for 55, 13 lakh is for 65, 15 lakh is for 75, how much has to be for 85? Students always remember, direct material and direct labor are always variable. I'm repeating, direct material, direct labor, direct expenses, the direct cost is always variable. In other words, the prime cost is always variable. All right. Prime cost is the actual direct production cost. It's always variable. You don't even have to check. All right. But yes, you can check and calculate the value for 85%. Come on. Calculate the value for 85% for direct material and direct labor. Then we'll come to, and yes, direct material, whatever comes for 85% plus 8% increase in direct material for 8%. So calculate the value for 85% then plus 8%, the change in the cost. Clear? So how much comes for 85%? If 15 lakh is for 75%, 15 lakh, how much is for 85? It is 17 lakh. 70 lakh plus 8%. So direct material 17 lakh plus 8%, the increase in cost. Plus 8%, it comes to 18 lakh 36,000. Direct material comes to 18 lakh 36,000. 18 lakh 36,000 direct material. Similarly, calculate for direct labor. Yes, very good. Similarly, calculate for direct labor. It's totally variable. First calculate 85%, then added by 5%. Then added by 5%, increasing cost of direct labor. Then added by 5%, please, quickly. Added by 5%. It should come to 8,92,500. Direct labor, 8,92,500. Check your answers. First calculate for 85%, then increase the amount by 5%, increase in direct labor. 8,92,500. Just check the answer. Any other answer? Or is it the correct answer? 8,92,500. Students, I want the answers, please. Yes, 892,500. Now let's move to factory overheads. Variable factory, fixed factory. So factory overheads are semi-variable. Factory overheads are semi-variable. Because in the question it's mentioned, variable factory overheads will increase by 5% and fixed factory overheads are increased by 10%. So that means factory overhead
are semi-variable. Similarly, selling overheads are also semi-variable. Administrative are fixed because administrative, nothing is mentioned about variable. Administrative are fixed. See, you can see 160, 160, 160. Administrative are fixed. So 1,60,000 plus 10%. Administrative are 1,76,000. Clear? I've done administrative, which appears to be fixed. So administrative are fixed. You just add 10% because administrative are increasing by 10%. Factory overhead and selling overhead are semi-variable. Students, can you tell me the variable portion and the fixed portion in factory overheads? How we do it? Just take two level of activity. So I am taking here 310 and 330. We have to segregate factory overheads into variable and fixed. Let's do it. Take any two level of activity. Either take 55 and 65 or take 65 or 75. You can take any two. I'm taking 55 and 65. Difference in amount 20,000. Difference in amount 20,000 and difference in the units. So 55% units are 55,000. 65 units are 65,000. 75% units are 75,000. 85% units has to be 85,000. We have been given units at 75%, which is 75,000. So we have assumed at 55% the units must be 55. At 65% the units must be 65. 75% we already have at 75,000. 85% we will be projecting. It should be 85,000. Clear? Now let us segregate factory overhead into fixed and variable. Difference in amount, I'm taking 55 and 65% category. Difference in amount is 20,000. Difference in unit is 10,000. So 2 per unit is the variable cost under factory overheads. 2 per unit. So 2 into 55,000 comes to 1,10,000. 2 into 65,000 comes to 1,30,000. So students, out of 3,10,000, variable cost is 1,10,000 and the balance fixed cost should be 2 lakh. Similarly, for 65%, out of 330, variable cost is 1,30,000 and fixed cost has to be 2 lakh. Clear? So it makes to 330. So we have segregated factory overheads into variable and fixed. Fixed factory overheads are 2 lakh. Variable factory overheads are 2 per unit. I'm repeating. Fixed factory overheads comes to 2 lakh and variable factory overheads are 2 per unit. Now let us calculate for 85%, that is 85,000 units. Let us calculate in the same way. I'm just calculating here now for 85,000. So variable factory overheads are 2 per unit. So which becomes 2 per unit into 85,000. 2 into 85,000, it comes to 1,70,000. Variable fixed overheads has to be increased plus 5%. Clear? Plus 5%. So variable factory overheads, make it a separate head. Variable factory overhead should be, I'm writing it over here. Variable factory overhead should be for 85,000, 178,500. Coming to fixed factory. Fixed factory are 2 lakh as we have calculated. And fixed factory are increasing by 10%. So plus 10%. Fixed factory comes to 2,20,000. So these are the total factory overheads. Variable factory 2 per unit. So whatever is the 2 per unit plus 5% increase. Fixed factory 2 lakh plus 10% increase. So this should be very, very clear. You want the zoom. Okay. I think it's clearly visible. So I hope you have understood the segregation of fixed factory and variable factory, right? This is any doubt on segregation of fixed factory and variable factory? 398. Yes, perfect. So total fixed factory, total factory overheads are 390. You don't have to do total, students. Please leave it fixed factory and variable factory. Just leave the segregation. You don't have to do the total. You just leave as separate only. Okay. Coming to selling overheads, similarly, you have to segregate the variable and fixed selling overheads. Students, similarly, you have to segregate the fixed and variable selling overhead. Take any two level of capacity. You can take again 55 and 65 only. So I hope factory overheads are clear. Shall I raise it off? So factory overheads we are done with. All right. I'm just raising the factory overheads now. Let's quickly discuss the selling overheads now. Selling are also semi-variable. So selling 320 and 360. Selling are 320 and 360. The difference in amount is 40,000. Difference in amount is 40,000. Difference in quantity is 10,000. We are segregating selling overheads into fixed and variable. So we are calculating the variable portion per unit. So variable is 4 per unit. Variable selling is 4 per unit. So 4 into 55,000 and 4 into 65,000. Calculate the variable amount first. Clear? So 55,000 into 4 comes to 2,20,000. So the balance is 1 lakh. 1 lakh is fixed selling. Fixed selling is 1 lakh since variable comes to 2,20,000 and the total is 320. So out of 320, 220 is variable and 1 lakh is fixed. Similarly, let us see for 65%. 65,000 into 4. 2,60,000 comes to variable and out of 360, 260 is variable. Fixed cost is 1 lakh, which should be 1 lakh only. So fixed cost in selling overheads is 1 lakh and the balance is variable selling, which is 4 per unit. Similarly, calculate for 85,000 now. We have got to know the variable selling. We know the variable fixed. Now calculate for 85,000 units also. Clear? I'm just erasing it off now this. I hope you have understood. So 4 per unit. Now let us calculate. Variable selling is 4 per unit. Multiply by 85,000. Clear? So 4 into 85,000 comes to 3,40,000. Variable selling has to be increased by 8% plus 8%. Add 8% to variable selling because there is increasing cost. Fixed selling is 1 lakh and increased fixed selling by 15%. Increase the fixed selling by 15%. Yes, increase the fixed selling by 15%. So how much variable selling comes to? 3,40,000 plus 8%. 367,200. 367,200 is your variable selling and fixed is 1,15,000. Just cross-check the answers, please. 367,200 fixed variable selling and 1,15,000 fixed selling. Administration we already had. So we have taken into account. So the segregation of semi-variable into fixed and variable you will come across at many levels. Here in many questions, in many units, because it's such an important and common concept that you will encounter it in any costing question. All right. So you should be very thorough how we segregate semi-variable into fixed and variable. It's very, very useful. So you should be thorough. All right. So students, can you calculate the total cost, please? Calculate the total cost. We have to calculate profit also. What is required? You can see. Calculate the profit. First, you have to make a flexible budget at 85%, what we are doing. All right. So 85% we have already made. Direct material, direct labor, administration. This is factory. This is factory. And this is selling. Clear? And this is selling. And then you have to calculate the profit and then the contribution. Right? So you should have the total cost. Please calculate the total cost. We have this material, labor, administration, factory, and then the selling. Calculate total cost, please. Let me have total cost from your side. Students, let me have total cost from your side. Total cost 37,85,200. Is this the total cost? Shall I take it as a total cost? 37,85,200 total cost. 37,85,200 is the total cost. Is this the correct answer? Total cost. Shall I take this as total cost? Any other answer for total cost, or shall I take it as correct? Shall we take it? Any other answers? Other students must be calculating. Direct material, direct labor, variable factory overhead, variable selling, then fixed factory, fixed selling. You should always keep variable separately and fixed separately, because you have to calculate contribution also. Students, here you have to calculate contribution. So you should always keep variable separately and fixed separately. I think that is the purpose here. So what you can do, you can make this format also. Sales less direct material, direct labor, variable factory, variable selling. Clear? Because you have to calculate contribution also. So sales minus variable cost will give you contribution. Then less fixed cost. Then profit. Clear? But for the time being, we have calculated total cost. We have to add profit. Is this the total cost? All right. So we have got answers for the total cost. 37,85,200. I'm going with this total cost. Profit is 20% on sales. Profit is 20% on sales. But we have to calculate on cost. So how much has to be the profit? If profit is 20% on sales, it should be 25% on cost. How you calculate? 37,85,200 into 20 divided by 80. Clear? 20 divided by 80. Because if 20% is profit, 80% has to be cost. So, or 25% of cost. So 37,85,200 is the cost. Profit is given on sales, but you have to calculate on cost. So if 20% on sales, it becomes 25% on cost, 1 by 4. Clear? It becomes 25% on cost. If 20% is profit, 100% is sales, 80% has to be cost. Clear? So just calculate the profit. Can I have the profit amount, please? Anybody who can give the profit amount, please? Anyone who has calculated profit, still calculating? Okay, 557,040 is the profit. I hope it's not correct. It should not be. 946,300. Okay, 946,300 appears to be correct. 946,300. 25% on cost. If it is 20%, students, if you are calculating at 20%, it will be wrong. It's 20% on sales, but you are calculating on cost. So if it's 20% on sales, it has to be 25% on cost. So it should be 25%, not 20%. These are the things where students make mistakes. So you should be thorough with these basic concepts. This profit is generally given on sales, and most of the time you have to calculate on cost. So you should be thorough with this concept. All right. So now the total sales should be, cost we know, profit we know, the sales should be 47,31,500. So this is the sales we have reached at the conclusion of the question. Sales should be 47,31,500. 47,31,500 has to be the sales. 47,31,500 should be the sales. So we have calculated sales. We have calculated the profit. Students, you have to calculate contribution. How to calculate contribution? I told you. Sales minus variable cost. You just have to calculate contribution. You know the sales. You know the variable cost. What all? All the variable cost. Direct material. You know the direct material, it's variable. You know direct labor, it's variable. You have to pick variable factory. This is variable factory. So this you have to pick. This you have to pick. This is direct material. This is direct labor. Variable factory you have to pick, and variable selling you have to pick. So deduct these four costs, four components of variable cost from the sales. You will get contribution. I'm repeating. You have to calculate contribution also. You must have done marginal costing by now. How we calculate contribution? Sales minus variable cost. You know the sales minus variable cost. Deduct variable cost and you will find the contribution. Variable cost has four components here. Direct material, which is always variable. Direct labor, which is always variable. Out of factory overheads, we have to take variable factory. Out of selling overheads, we have to take variable selling. For variable costs, please deduct from sales. You will get contribution. Can I have the amount of contribution? Okay, 1457,300. 1457,300 is the contribution. 1457,300 is the contribution. Any other answer, students? Any doubt in the contribution? So this we have reached at the end of this solution, this illustration, a very good illustration, a master budget with a flexible budget. So we can generally maybe we make a combined budget. Flexible budget can be combined with any budget. Flexible budget can be combined with master budget, any functional budget. So because flexible budget is nothing but a different capacity. So this is a very good example of a master budget and flexible budget together. Clear? Students, all these illustrations are from either your RTPs or your past question papers. So, you will have an idea how the pattern is and what is expected out of you and how you have to calculate. Everything is important. All right. The presentation of the solution, the working notes, how you understand the illustration, how you approach the question. You should always write, working notes. You should always write assumptions and footnotes that will, clear. The examiner will think that, okay, you have the clarity of the concepts, and that's very important. We'll see if we have a clear solution. Yes, we do have a clear, neat solution also to it. So budget for 85% capacity, units are 85,000. See, the variable portion you should always keep at the top, especially when you can see that question is asking a contribution also from you. So if the contribution is also required, it's better that you keep all variable costs together. All right. So these are all this is the total of the variable cost. It's going to help if you do it this way. So, and fixed together. So this is the total cost. This is profit. 20% on sales, 25% on cost. So if all the students who have calculated 20%, then it will be wrong. Clear? I think there all the mix of illustrations are there. I'll see if illustration 5 also we can include in the next session. But all these illustrations are from the study material and your RTPs and past years papers. So all mix of practice questions are taken from the, institute material only. So sales and then contribution of cost, sales minus variable cost. And this is the contribution. So very good practice question for a master budget and the flexible budget. All right. Let us see if there is any other illustration. All right. So students, this is the probably the last illustration for this session. And we have so many budgets. The rest of the budgets we'll be doing in the next session. Take a note of this illustration. Jigyasa Limited is drawing the production plan for its 2 products. I'll explain you this illustration, students. You will do calculations on your own. All right. I'll explain you the illustration. I'll explain you how you have to approach this. And then all sorts of calculation and proper format you have to make as a homework. In the next session, you should be ready with the final solution and with all the calculations which is required in this question. So let us try to understand the illustration. So there are 2 products, MM and HH. Clear? The company's policy is to hold the closing stock. See, we always estimate the closing stock also. How much inventory we need to maintain. That is also part of the planning. So this time the company policy is to hold finished goods at 25% of the anticipated volume of sales of the succeeding month. So 25% of the sales of the next month will be the closing stock of the current month. Clear? That means if we are talking about April, then 25% of the sales estimate of May will be the closing stock for April. All right. So closing stock policy is being given in the question for the first time. So closing stock will be 25% of the anticipated sales of the succeeding. Succeeding means next month. Next month means the following month. All right. Successive month. So the following are the estimate data for 2 products. So we have the budgeted units, production units. 180 and 120 are the budgeted production units. So production units for the entire year is given. Direct material cost per unit, since it's variable, it will be in per unit. Direct labor is always variable, so it's given as per unit. Manufacturing overhead generally is fixed, so it's given in total. So the total manufacturing overheads are given and material and labor cost per unit is given. All right. The estimated units to be sold in the first 4 months, April, May, June, and July. So see, sales are given. That means you have to make a production budget for the first quarter in month wise. First quarter means what all months? See, 4 months are given. We have to make a production budget for first quarter of the year. Can you tell me how many months and which months we have to take for the first quarter? I'm repeating. Students, we have to make a production budget for the first quarter, month wise. So what all months we have to take for the first quarter of the year? What all are the months which constitute the first quarter? 4 months are given to you. Out of these 4 months, what will be form part of the first quarter? We have to make the budget of only for the first quarter. Can you tell me the months in the first quarter? I hope this much you know. I want the answers from you so that, you see, I'll keep on talking and talking. It should always be, I should know that you are listening also. Yes, April, May, and June. We have to make a production budget for April, May, and June. July is given because we have to calculate the closing stock. All right. So students, I'm just explaining you have to solve it. Production budget. What is the format of the production budget? I told you. We have to calculate first the sales. So I'm just explaining here. We have to make the budget for April, May, and June. I'll just explain you. I'll not solve it. You will solve this question as a homework. You should have the solution for this question. Do it on your own. Try it on your own. Do mistakes, don't worry, but do it on your own. Be ready with the solution. The next session will start with the solution of this question, right? So April, May, and June, you should have the sales. Sales we know of both the products. So MM and HH, both the products you have to do. Let us do it for MM first. MM and HH. You have to do it for both the products. So this is the format of the production budget. We always start with sales. We know the sales. Sales are given in the question. For MM, the sales are 8,000. For May, the sales are 10,000. For June, the sales are 12,000. I'm doing for MM, minimax. Clear? Format of production budget. To the sales, we add the closing stock. So that will give you the total requirement less opening stock. Clear? Less opening stock, and then you will get the production required. Production to be done. Clear? In units. All right. Sales is given to you. You have to add the closing stock. Then you have to deduct the opening stock. And then the final answer will be production units. That is your answer. So this production budget has to be made in units and cost, both. Units and cost, both. So once you know the cost of the product, we have the solution also. I'm not showing you the solution. You have to do it on your own. So you have the sales, closing stock. What is given under the closing stock? Closing stock is 25% of the anticipated sales of the existing month. Okay, so let me just do it, explain you how you do the closing stock. The 25% of the succeeding month. So 25% of the sales of May will be the closing stock of April. 10,000, that means 25% is 2,500 will be the closing stock for April for MM. All right. Closing stock. Succeeding month. That means 25% of the May sales will be the closing stock for April. 25% of the June sales will be the closing stock for May. All right. So accordingly, you have to do, just do it like this. 25%. That means 3,000 will be the closing stock for May. 25% of the sales of July will be the closing stock for June. So that means it has to be 4,000. This is the way we have calculated closing stock. How? 25% of the sales of May will be the closing stock for April. 25% of the sales of June will be the closing stock for May. 25% of the sales of July will be the closing stock for June. 2,500, 3,000 and 4,000. I'll stop here. You have to calculate and complete this format, production in units, and then you have to calculate production in cost. Clear? So this, you have to find out the total. See, we know the total requirement now, 10,500, 13,000 and 16,000. You know the total requirement. You have to find out the opening stock now and then the production units. I'll stop here for this session. We will resume the session day after tomorrow for the last session in budgetary control, and lot more budgets, lot more exercises for you coming on that session. But we will start with this illustration. You should be ready with the solution. All right. So with this, I'm closing the session today. Hope you have understood all the concepts, students. Any queries, anything, you can always get back with the queries in the next session. And till then, happy learning. All the best to all of you. Thank you.